Nigeria recorded a significant slowdown in inflation in October 2025 as headline inflation eased to 16.05%, down from 18.02% in September. New data from the National Bureau of Statistics shows year-on-year inflation dropped to 17.82%, a sharp contrast to the 33.88% seen in October 2024, partly influenced by the adoption of the new base year. Welcome to Business Point, where we extract the Nigerian economy and the government policies. I am Kike Lomo Okeri. Month-on-month inflation rose slightly to 0.93%, reflecting a faster increase in average price compared to September 0.72%. Urban inflation moderated to 15.65% year-on-year, a major fall from 36.38% in October 2024. However, month-on-month urban inflation climbed to 1.14%, up from 0.74% the previous month. The 12-month average urban inflation rate was 22.68%, also lower than the last year's 34.52%. Rural inflation followed the same easing trend, dropping year-on-year to 15.86% from 31.59% in October 2024. Month-on-month rural inflation slowed to 0.45%, down from 0.67% in September. The 12-month average rural inflation rate was 20.81% compared to 30.24% a year earlier. Food inflation shows one of the sharpest decline, dropping to 13.12% year-on-year, a 26% point fall from the 31.16% recorded in October 2024, heavily driven by the statistical impact of the new base year. Month-on-month food inflation stood at 0.37%, an improvement of minus 1.57% in September. Price increases were recorded in items such as onions, oranges, pineapples, shrimp, granules, vegetables including ugu and okazi, and meats like goat meat, cow tail, and liver. The average annual food inflation rose to the annual average food inflation rate fell to 21.96% from 38.12% recorded the previous year. This drop in inflation signals the inflationary pressure in Nigeria is cooling more sharply than many expected. While the drop partly reflects a change in base year, the underlying trend shows genuine improvement. Food prices are stabilizing and the foreign exchange market has become less volatile. However, the uptick in the month-on-month inflation suggests that price pressure are fully gone. Sustained policy consistency, FX stability, and better production condition will be crucial to keeping inflation on a downward path ahead of 2026. Nigerian external reserve has climbed to $46.7 billion, buoyed the latest Eurobond issuance and the strongest wave of the foreign exchange inflow seen in 6 months. The boost in liquidity helped the Naira hold steady in the official markets on Monday, even as the demand pressure persisted. CBN data shows that the Naira slipped slightly by 0.4%, closing at 1,448.03 Naira per dollar compared to 1,442.43 Naira on Friday. In the parallel market, the currency firmed marginally to 1,455 Naira and from 1,457 Naira, reflecting improved dollar supply. The sharp rise in reserves is tied to renewed offshore investors' appetite and fresh Eurobond proceeds. October delivered the highest FX inflow since May, with FMDQ figures showing a 91% month-on-month jump to $6.1 billion, approaching the $6.7 billion peak recorded earlier in the year. Analysts link the surge to Nigerians' elevated interest rate, favorable rate differential against the U.S. market, and a revived hunt for yield among global investors. Investors' confidence has been further reinforced by the heavy 400% oversubscription of the Nigerian recent $2.35 billion Eurobond and the S&P upgrade of the country's outlook to positive. Portfolio investors dominated FX inflow in October, contributing more than half of the total receipt. Inflows into fixed income instruments alone hit $3.4 billion, reflecting strong demand for high-yield domestic assets. Retail investors' participation also jumped sharply to $602 million from $104 million the previous month. However, foreign direct investment weakened, dropping to 25% to $222 million, underscoring lingering structural concern around security and policy consistency. Despite the MPC 50 basis point rate cut to 27%, the first since 2020, Nigeria still maintains one of the world's highest policy rates, keeping portfolio flows strong. The Naira's relative stability and moderating inflation, which is for the 7th straight month to 16.1% in October, are also supporting sentiment ahead of the further potential policy easing. The jump in the reserve signals a decisive return of foreign capital to Nigeria's financial markets, driven largely by short-term portfolio rather than long-term investments. While this strengthens the Naira and boosts confidence, it also exposes the economy to sudden outflow if global conditions shift. Sustaining this momentum will require deeper structural reform, stronger security conditions, and policies that attract more durable FDI. Nigeria's trade with other African countries expanded by 14% in the first half of the year, driven by renewed government efforts to strengthen regional economic ties and remove long-standing barriers to cross-border commerce. The value trade between Nigeria and the rest of the continent rose by 600 billion naira to reach 4.82 trillion naira in the 6 months ending June. According to Comptroller General of Customs, Bashir Adewale Adeniyi, who spoke at the Regional Trade Conference in Abuja, Adeniyi says the upswing reflects a broader shift towards deeper regional integration, with Nigeria's exports to ECOWAS member states rising sharply. He noted that the trend underscores Nigeria's growing influence as a major trading hub for West Africa and emerging center for continent-wide value chain. Customs officials attributed the rise to ongoing reform aimed at simplifying documentation processes, modernizing border operation, and improving transport link with neighboring countries. Interventions that have begun to ease the bottleneck that historically slowed the movement of the goods across the African borders. Adeniyi says the government is also accelerating efforts to operationalize the African continent free trade area, positioning Nigeria to benefit from the world's largest free trade zone. Industry, Trade and Investment Minister Jumoke Oduwole highlighted recent measures, including targeted tariff concession and the launch of a dedicated air cargo corridor to East Africa. She says the corridor has reduced export logistics costs by as much as 75% and is encouraging more Nigerian businesses to compete in high-value regional markets. Taken together, the reform are reshaping Nigeria's trade landscape, boosting competitiveness, strengthening regional supply and chain, and gradually unlocking the potential of intra-Africa commerce, which remain one of the continent's most powerful engines for growth. Nigeria's 14% rise in intra-Africa trade in transmission was due to technical issue. All right, still on intra-Africa trade. While the gain signals growing regional competitiveness, sustaining this momentum will require consistent, broader reform, expanded infrastructure, and deeper private sector engagement to convert early improvement into long-term continental market dominance. The executive chairman of the Federal Inland Revenue Service, Dr. Zach Adedeji, says President Bola Ahmed Tinubu's sweeping tax reform are central to rebuilding Nigeria's fiscal strength and positioning the country for long-term economic resilience, addressing academics, policymakers, and industry leaders at the maiden lecture series of the University of Ilesha, Osun State. Adedeji says Nigeria's revenue struggles should be seen not as a physical emergency, but as a strategic opportunity to fix long-standing structural weaknesses. He noted that the global public finances are under pressure from digital disruption, climate risk, rising debt, and overlapping economic shock, making reform both urgent and unavoidable. Adedeji outlined a broader part of the Nigeria's economic stability anchored on four major pillars: fiscal flexibility, coherent policies, strong institutions, and a workforce equipped to adapt a rapid global changes. He stressed that the country must aggressively expand non-oil revenue modernization, its tax administration, and invest in skill development to remain competitive. He highlighted ongoing reform under the administration's Renewed Hope agenda, including the automation of the tax processes, wider deployment of the Tax Pro Max platform, improved taxpayer identification system, and deeper collaboration with state governments to eliminate fragmentation in the tax structure. These reforms, he says, are aimed at improving efficiency, boosting compliance, and enhancing transparency across the tax ecosystem. Adedeji also challenged Nigerian universities to play a more active role in shaping national economy policies. He called for stronger collaboration between the academia and government in designing evidence-based models for digital taxation, domestic revenue mobilization, and economic diversification. According to him, higher institutions can serve as engine of innovation and critical partners in strengthening Nigeria's economic competitiveness. Adedeji's message reinforces a growing consensus that Nigeria's fiscal future depends on how quickly it can shift away from oil dependence and modernize its tax system. The emphasis on automation, harmonization, and stronger institutions reflects global best practice. However, the success of this reform will hinge on sustained political will, consistent enforcement, and deeper engagement with state and private sector to ensure broader compliance and long-term revenue growth. All right, let's take a quick short break now. We will be right back. Don't go away. Stay with us. Welcome back. If you're just joining us, it's Business Point, where we extract the Nigerian economy and the government policies. Nigeria fixed income markets rallied strongly in the weekend, Friday, November 14, as massive liquidity of 6.17 trillion pushed yield downwards across Treasury bill, OMO bill, and government bond. The surge in the liquidity reserve, the mild rate uptick recorded the previous week, when the total debt value at the FMDQ climbed to 91.89 trillion naira from 88 trillion naira. The jump in the liquidity was fueled by large placements at the Central Bank of Nigeria's standing deposit facility, sizable OMO maturities, and primary market repayments. These inflows expanded net liquidity by more than 57%, week on week, despite the excess cash. The overnight rate inched up slightly to 24.9%, while the other money market pressure eased, with NIBO and NITI yields trending lower as the bank has less need for borrowing. Analysts expect liquidity to remain buoyant, supported by upcoming bond coupon inflow of 151.63 billion naira. The Treasury bill market saw intense buying interest as investors sought to deploy surplus cash. Average NTP yield dropped by roughly 44 basis points to around 17%, led by aggressive demand for the newly issued November 5 bill. OMO yields declined even further, falling by 50 basis points to approximately 21.7%. OMO market activity spiked after CBN sold 2.55 trillion naira worth of short tenor bill at the November 13 auction against subscription of 3.09 trillion naira and oversubscription exceeding 500%. Analysts expect demand to remain strong ahead of the DMO's 700 billion naira NTB auction on November 19, supported by fresh inflow and expectation of continued inflation easing. Nigeria's bond market closed the week on a bullish note, with investors moving into sovereign debt amid volatility in equities and other riskier assets. Average FGN bond yield fell by about 20 basis points to the mid-15% band, driven by strong demand in the short and mid segment, particularly this February 2031 and April 2032 maturities. Long-dated bonds were steady but supported improved government fiscal signals and a stable monetary backdrop strengthened investors' confidence, while the approaching November 2025 Eurobond maturity is expected to keep demand elevated. Nigeria's Eurobond continued to appreciate, with average yields dropping by 21 basis points to 7.77%. This reflects stronger external sentiment and rising global appetite for Nigerian sovereign risk. Forward rates declined mildly, indicating cautious edging as investors balance optimize with market risk. Nigerians' fixed income rally underscores the power of liquidity in shaping yields movement, with more than 6 trillion naira in system liquidity and easing inflation expectation. Short-term and medium-term yields are naturally compressing. Strong demand at auction, rising Eurobond confidence, and stable monetary signals point to sustained businesses in the near term. However, elevated overnight rates and cautious forward positioning suggest investors remain alert to potential liquidity tightening or micro shocks. All right, before we call it a wrap today, let's take a quick look at the stock market. The Nigerian equity opened the week on the negative note as all-share index fell by 1.26% to 145,159.77 points on Monday, erasing 1.17 trillion naira from investors' portfolio and pulling market capitalization down to 92.3 trillion naira. The sell-off was driven largely by a 10% slump in Dangote Cement, coupled with losses in major Tier 1 banks, including Zenith Bank, Access Holding, and FBN Holding. Despite the downturn, market breadth remained slightly positive, with 28 gainers against 24 losers. Sovereign Insurance led the gainers list, while the Dangote Cement and Emerald Well topped the losers chart. Market activities cooled significantly after Friday's unusual large turnover linked to off-market transaction in Cornerstone Insurance. Trading volume plunged by over 92% to 388.2 million units, while the value dropped to 31.1 billion naira. Tantalizer led in the volume, while Aradel Holdings accounted for 69% of the total value traded. Sector performance was mostly bearish. The Industrial Goods Index recorded the steepest drop. Oil and gas and banking indices also declined, while the Consumer Goods Index was marginally lower. The Insurance Index, however, closed slightly higher on gains from Sovereign Insurance. Analysts at Cowries Asset Management attributed the downturn to profit-taking, noting that sell pressure persisted despite the listing of nearly 2 billion new shares of Charm Holdings. Retail participation remains strong, with the number of deals rising even as the overall volume and value fell. The session coincided with fresh inflation data showing continued deceleration to 16.1% in October, although month-on-month inflation edged higher to 0.9%, signaling lingering price pressure. The sharp decline reflects renewed risk aversion as investors lock in profit amid shifting micro signals. Heavy sell-off in large cap stock like Dangote Cement amplified the market weakness despite the positive breadth. Rising retail activity suggests growing speculative behavior, while slowing inflation could support sentiment if sustained. However, fragile liquidity and persistent price pressure may keep the market volatile in the near terms. All right, this is where we call it a wrap on Business Point today. Join me again tomorrow on Global Television, channel 365 and 276 on Star Times. To stay connected, kindly follow us on all our social media platforms using at Global TV NG. Till I come your way again, I am Kike Lomo Okeri. I celebrate you all.